Strategy borrowed money for free to buy Bitcoin. Now they're retiring that debt at an 8% profit. Saylor's company just announced it will buy back $1.5 billion of convertible bonds it issued in 2029. The catch? They're paying only $1.38 billion. That's a $120 million discount on debt they created themselves. In traditional finance, you borrow money and pay interest to use it. Saylor flipped that model entirely. He borrowed at 0% interest, and now he's making money on the way out. Here's the mechanism nobody talks about. When Strategy issued those convertible bonds, they came with a 0% coupon. No interest payments. Ever. Investors bought them anyway because convertibles include an option to convert the debt into Strategy stock if the share price rises enough. That embedded option was valuable when Bitcoin was volatile and Strategy stock was soaring. But Bitcoin has stabilized. The stock isn't moving like it used to. Suddenly those bonds, which promised zero income and an option that might never pay off, started trading below their face value in the secondary market. Volatility traders who bought them for the upside are now selling at a loss. Saylor saw the discount and acted. Strategy entered private negotiations to buy back the bonds directly from holders. The price? 92 cents on the dollar. For every $100 of debt they originally issued, they're paying $92 to retire it. That 8% spread goes straight to Strategy's balance sheet as profit. They didn't sell Bitcoin. They didn't raise new capital. They simply bought their own liabilities at a discount and erased $120 million in obligations. This is what financial engineering looks like when the market misprices your debt. Convertible bond arbitrage usually works the other way. Hedge funds buy the bond, short the stock, and profit from volatility. But when Bitcoin flattened and Strategy's stock cooled, those same arbitrage players got stuck holding bonds that weren't converting and weren't paying interest. They needed an exit. Saylor gave them one, but on his terms. The move cut Strategy's 2029 debt load in half. It strengthens the balance sheet without touching the Bitcoin holdings. And it demonstrates something most people miss about Saylor's playbook: he's not just accumulating Bitcoin. He's systematically exploiting every inefficiency in the capital structure around it. Borrow at zero. Buy an appreciating asset. Wait for the market to misprice your debt. Buy it back cheap. Repeat. There's a second-order effect here that matters more than the headline number. Every time Strategy retires debt at a discount, it increases the Bitcoin per share metric that investors actually care about. The company holds the same amount of Bitcoin, but it has fewer liabilities and fewer potential shares outstanding if those bonds ever converted. That makes each existing share more valuable in Bitcoin terms, even though the underlying holdings didn't change. The question now is whether this was a one-time opportunity or the beginning of a pattern. Strategy has issued billions in convertible debt over the past few years. If Bitcoin stays range-bound and the stock remains flat, more of those bonds could trade below par. Saylor could keep buying them back, turning what was supposed to be cheap leverage into actual profit. The debt that was supposed to dilute shareholders ends up concentrating value instead.